Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Okay, we have a few questions this week. First one, what happens if my life insurance policy lapses? Well, you can reinstate it by paying any past due premiums. You might also need to get underwritten again by the insurance company to make sure that you're still insurable. That can potentially be a lengthy process. It really depends on the conditions of the lapse and the terms of your policy. Some companies will let you reinstate right away. Others, they'll let you reinstate, but they're going to want to verify that you haven't had a change in your health, since the lapse. The good news is with whole life insurance that you really have to try really hard to lapse your policy. If you miss a payment, the insurance company is going to remind you. First of all, they're going to send you a notice because say, hey, you didn't pay your premium. If you can't pay the premium for whatever reason out of pocket, they're going to use something called an automatic premium loan, which is going to borrow money against the cash value to pay the premium. And that will keep your policy in force. And then if there's not enough cash value to cover the base premium on the policy, the insurance company is going to switch your policy to, someone will switch it to like a extended term insurance, but on my policies, I try to go for a reduced paid up policy so that you don't lose it. So it's really difficult it's really, really hard to lapse a policy, on a whole life policy. I mean, you have to go through a lot of steps in order for that thing to actually lapse. So for the most part, you're not going to run into that situation. As long as you're making premiums and it happens once in a while. Now, if you're just, not paying premiums all the time, you're just skipping them and you're not really paying any attention whatsoever, sure, you could lapse the policy. Reinstating it would be a matter of paying the premiums and trying to get the thing put back in force. Okay, so that takes care of that one. The second question: how is the insurance company calculating? Wait a minute, how is the insurance company calculating my dividend? And how do I know if they are paying me the right amount? So there's no way to audit an exact dollar amount, right? So the way that life insurance companies are calculating the dividend payments is that the dividend is actually determined by a committee, and that committee it's the board of directors basically, and they're trying to decide how much of divisible surplus can they afford to pay policyholders this year. The way the contracts are written, they have to pay divisible surplus. If there's money that can be paid as a dividend, they have to pay it as a dividend. They have to pay. They're not allowed to not pay. So that's what they do. So the exact calculation is complex and may include input from many different lines of businesses. So insurance companies generally don't share the exact calculation because they consider it a competitive advantage that they don't want to share with their competitors. However, if you look on your life insurance company's financial statements, they do tell you exactly what goes into the dividend and how much it's going to be paid. There's an exact formula for doing that, and even though they don't disclose that, you can sort of reverse engineer how it's being done. Specifically on their financial statements, you'll see supplemental lines of business, and then you'll see a line item on the financial statement that says dividends paid to policyholders, to participating policyholders, and it shows the dollar amount. And you take that dollar amount, you take those dividends paid, and you just match them up with their company's investment income, with what's called their net income, and that net income is a combination of all of the profits that they're making from all their other lines of business. So investments, and if they own a health insurance division and term insurance, annuity business, whatever. So you can see like net income flowing directly into the dividend payment. So that's where it's coming from. And so each year, the board of directors of the insurance company declares a dividend payment, and when you are paid your annual dividend, you can check the dividend yourself. You can plug it into the formula. I keep a formula on my website on monogenics.com, but basically, it's going to be, you're going to be like premiums paid less expenses. So they take expenses out, and then whatever's left over, they credit back the dividends. So you can kind of plug into a little formula like that. If you know your premium payment, and then the dividends paid, you can kind of reverse engineer how much it's supposed to be. The expenses are supposed to be. So, and then you can figure out whether or not the dividend makes sense, based on that. So when these payment systems are automated, so it's unlikely that you're ever going to be shorted on your dividend. But if you'd rather check each year's dividend payment, you could. It does take a little bit of work and some spreadsheet skills to figure it out, because you're basically checking the insurance company's math based on their basic dividend formula. But it can be done. So anyway, I hope that answers the question. It's if you're not familiar with it, and you're not familiar with reading financial statements, it could be a little, I guess, tricky, and that's why the insurance company tries to make things as simple as possible. They're not going too deep into the mathematics behind it. Sometimes that can confuse people. I mean, there's nothing necessarily bad about transparency. It's just that a lot of people simply don't understand how the thing works. And you can understand how it works. You just have to go into their financial statements, and then also just reading the company's literature. Most companies publish something about the dividend, and some will go into more in depth into the basic formula for how they're calculating their dividend. So it's a lot of policyholders don't care about that stuff, but you could if you really wanted to, you could dig into it and figure it out. Let's see what happens. Okay, so the next question: what happens to my policy if I end up in a nursing home? Okay. Wow, that was a switch. So if your policy has a chronic illness rider, you can spend down the death benefit of the policy to help pay for those long-term care expenses. So the chronic illness rider is not long-term care insurance. So I need to state that up front, because a lot of people get confused by that. They're, I have long-term care on my policy. Chronic illness is a separate type of benefit payment on a life insurance policy. So the chronic illness rider, it doesn't function exactly like a dedicated LTC policy, but it will pay a benefit that you can use to pay for nursing home care. So if you decide not to use your policy for that and try to file a claim with Medicaid for financial assistance, they're going to make you spend down all of your assets, including cash values of life insurance before any of those state benefits kicked in. So if you put your life insurance policy in a trust, there's a 60-month look back period to see if any assets were transferred into those kinds of trusts. So any transferred assets within 5 years are going to be included in the Medicaid calculation. So the bottom line is that no one's going to take away your life insurance policy, but you generally won't be able to claim state benefits without exhausting all your personal assets first. And really, that's what those chronic illness riders are for. It's supposed to protect you. So if you have the benefit, and some carriers have more generous benefits than others. I know at the time of this recording, New York Life has a very, very generous chronic care rider that functions almost exactly like a long-term care policy. It's not long-term care insurance, but it functions just like it, and it's phenomenal. It's a very generous benefit pool, and a lot of flexibility in that. Other carriers are also pretty good on it. Guardian's pretty good on theirs. So you've got some carriers out there that do a really, really good job on these chronic care riders, chronic illness riders. So if again, it's not a replacement for a true long-term care policy. There's some things that benefits that you might get, like inflation protection and stuff like that, on a long-term care policy that you don't necessarily get on a chronic care rider. But I guess the caveat to all this is that, with a life insurance policy, you are not locked into paying premiums on a LTC policy that you might or might not use. And that's what scares a lot of people about long-term care insurance, is that the premiums are expensive. You might not use the policy, and for the most part, you're not getting your premiums back. So if you don't use it for long-term care, it's unlikely that you're going to get the premiums back. There's not really provisions for that, for premium refunds. And if companies do offer something like that, it's going to be a rider that you have to select, and that rider is going to be very expensive because those policies are it's an expensive rider to put on a policy. I know with the term insurance that have return or premium riders, those are expensive, and that's life insurance. And now we're talking about long-term care insurance, which is a form of health insurance. And it is a very special type of insurance that's very, very expensive. Almost by design, it's very expensive. So it's not a simple thing. You're basically going to be putting premiums into a policy that you hope you do not want to have to use your long-term care policy, because that means that something really bad has happened to you. But at the same time, if you don't use it, you've spent a lot of premium dollars on something that you don't benefit from. It's a really kind of strange sort of type of insurance. I would say if you have lots and lots and lots of assets and you have the disposable income to do it, if it were me, that's a policy I would buy last. Just because you can get very, very close with life insurance and chronic illness riders. You're very close. And you could even get really close if you want long-term care insurance. You could get really close by buying an LTC, a true LTC rider on a life insurance policy. They function just like long-term care insurance. The difference is that you are not having to. You still get life insurance. So if the long-term care benefit doesn't pay off on your LTC rider, on your insurance policy, then you get the benefit back because it'll pay off when you die. You'll get all the money that you put in for the long-term care side gets converted into a death benefit. So you literally can't lose, on that side of it. With the LTC policy, you do lose. If you don't claim the benefit, you just lost all those premiums. So it's, it really something to think about. I very rarely does anyone, that I'm doing business with that demand to have long-term care. It happens once in a while, but it's something to think about. Those policies, you have to be very careful about how you're spending your money on those. So anyway, I hope that answers your question. Thank you again for the questions. Keep sending them in. And I'll see you in the next one. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.